Investment lessons from tulip speculation madness. Investing in stocks is an opportunity to bring great wealth to many people, but misjudgment and reckless investment can lead to great losses. The volatility and unpredictability of financial markets provide important lessons for investors, one of which is tulip mania, one of the most famous speculative bubbles of all time. This is an economic event in the Netherlands in the 17th century, showing how speculative frenzy forms and how devastating the consequences of it can be. The tulip speculative frenzy also has great implications for today's investors. Bubbles and collapses that often occur in the stock market or cryptocurrency market remind us of the lessons we can learn from the tulip speculative frenzy. In the early 17th century, the Netherlands was one of the centers of the world economy, a period that dominated global maritime trade with the success of the Dutch East India Company. This period is called the Dutch Golden Age, and the economic prosperity of this period offered new opportunities for the Dutch. As commerce and trade flourished, the Netherlands developed its financial markets rapidly along with its prosperous economy. Tulips are flowers originally from Turkey and Central Asia and were first introduced in the Netherlands in the late 16th century. Tulips were initially considered rare and beautiful flowers among the upper class, and their value was extremely high, especially for rare varieties. At this point, tulips are not just flowers, they have become a symbol of wealth and power. As a result, the price of tulips rose astronomically, and people gradually became more speculative about tulips. The demand for tulips began to increase sharply in the late 1620s. Initially, it was mainly traded among the upper class and wealthy merchants, but gradually the middle class and even farmers entered the tulip speculation. During this period, various varieties of tulips were developed, and the Iris tulips with rare patterns were especially popular. The price of tulips continued to rise over time. During this period, gift trading in the form of buying and selling future tulip bulbs rather than physical tulip bulbs was also prevalent, which sparked a larger speculative craze. Many jumped into speculation with the expectation that tulip prices will continue to rise, which has resulted in prices soaring even further. The peak of tulip speculation was from 1636 to early 1637. During this time, the price of some tulip bulbs was so high that they far exceeded the average annual income in the Netherlands. However, in February 1637, tulip prices began to fall suddenly, which led to a sharp collapse across the market. The drop in prices has sparked panic among investors, with many no longer buying tulips at higher prices. This resulted in a sharp drop in demand, and the value of tulips fell in an instant. The collapse of tulip speculation has caused huge financial losses to countless people, and the economic repercussions have spread throughout the Netherlands. Confidence in the financial system has collapsed, which has led to an economic recession. Eventually, the tulip speculation frenzy went down in history with economic lessons. The tulip speculative frenzy shows how excessive optimism can lead to dangerous situations. At the time, many investors were obsessed with the belief that tulip prices would continue to rise, which led to a loss of reasonable judgment. This over-optimism has resulted in investors underestimating the risk, resulting in greater losses. Similar examples can be seen in today's stock market or cryptocurrency market. When the price of a particular asset rises sharply, many people become obsessed with the expectation that the price will continue to rise. However, this is a very risky strategy, and investing without taking into account the volatility of the market can result in huge losses. The tulip speculative frenzy illustrates how crowd sentiment can dominate the market. When people saw others around them investing in tulips, they thought they should invest, which resulted in higher prices. Crowd psychology blurs rational judgment, and it is easy to lead to emotional investment. This phenomenon is often seen in modern financial markets as well. When a particular asset starts to gain attention in the stock or cryptocurrency market, people think it's worthwhile and invest in it on a large scale. In this process, asset prices are overestimated and bubbles are formed. In order not to be swept away by crowd psychology, cool judgment and analysis are essential. Another important lesson from the tulip speculative frenzy is the importance of diversifying investments and managing risk. Many people invested their entire fortune in tulip bulbs, which led to huge losses when prices collapsed. It is very risky to invest all your funds in one asset, and to avoid this, it is important to distribute your investments in various assets. Modern investors can spread their risk by investing in a variety of assets such as stocks, bonds, real estate, gold, and more. It is also important to have an appropriate sales strategy in case the value of your investment property drops sharply. These risk management strategies help minimize investment failures and deliver stable long-term returns. One of the most important lessons in the tulip speculative frenzy is the importance of investment judgment based on real value. When the price of tulip bulbs rose astronomically, the judgment of whether they were actually worth it was put on the back burner. Investing without considering real value is a risky strategy, and it is likely to lead to losses in the long run. Modern investors need to develop the ability to evaluate the intrinsic value of their investment assets. When purchasing a company's stock, you should consider its performance, growth potential, and location in the industry. And when investing in cryptocurrency, you should also examine the practical utility or technical foundation of the project. This judgment serves as the basis for a long-term and successful investment. The tulip speculation frenzy shows that short-term speculation may threaten long-term financial stability. The sharp rise in tulip prices attracted those seeking short-term wealth, but the result eventually led to economic instability. On the other hand, a long-term investment philosophy enables more stable and sustainable financial management. Instead of pursuing short-term returns, it is important to have a long-term investment strategy. This, likewise in the stock market, can be a better strategy to invest in anticipation of the long-term growth of a company without being swayed by short-term volatility. Investments from a long-term perspective are less susceptible to short-term market fluctuations and can produce steady performance. The tulip speculation frenzy was one of the most well-known speculative bubble events in history, and it left a tremendous lesson for people of that time. Lessons learned from this event: over-optimism, crowd sentiment, the importance of diversifying investments, investment judgments based on real value, and long-term investment philosophy remain valid for today's investors as well. Even in modern financial markets, bubbles are periodically forming and collapsing, and many people are experiencing great losses in the process. Remember the lessons learned from the tulip speculation frenzy, and cold judgment and strategic investment can minimize these risks. Investment should be aimed at financial stability and sustainable growth, not just increasing assets. The tulip speculative frenzy shows how devastating the consequences of short-term greed can be, reminding investors of the need to maintain careful judgment and long-term perspective. Ultimately, with these lessons in mind, we could be better investors. Please subscribe, notify, and like. It's a great help for me to produce a video. Thank you.